Hi, ladies and gentlemen. Welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Right. Good morning, everybody, and welcome to this morning's session. I'll introduce our team in a minute. I head up the Worksman's Insolvency Business Rescue and Restructuring team based in Sandton, South Africa. We were invited by the South African Accounting Academy to talk about the basics of business rescue, which we will do in a minute. Just a little bit about myself. As I said, I head up this practice group. I've been involved in business rescue and insolvency since the early 90s. I've been at my law firm for 35 years at Worksman's. And I have a real passion for the restructuring and rescue of companies, and it's something we do on a daily basis in our work life. So today we're going to go through various modules. We're going to talk about an overview of business rescue. We're going to talk about business rescue itself. There will be time for questions at the end. We should finish around about between 11:30 and 12 noon. And again, I think there is opportunity to ask questions in the chat box. So we'll try and deal with those questions as we go along. So, as I said, I am Director and Practice Area Head. Today, Becker, Director in my team, and Nastascha Harduth will be talking to the topics. And we hope that you enjoy the session. Try and keep it practical. We'll give examples of experiences that we've had along the way over the last, let's say, just over a decade of practicing in this space. So the various modules for today's session, I will give an introduction, overview of business rescue, very much focused on the important definitions for business rescue. And all of this can be found in Chapter 6 of the Companies Act 2008. We'll talk about how does business rescue commence, important features of business rescue. The objective, of course, is the business rescue plan, which is something that the practitioner would draft, put to the creditors for approval, and the company would be rescued in that fashion. We'll talk about who the business rescue practitioner is, where does he come from, what does he do, what is his skill set, what are his challenges, and then we'll end off with some of the stakeholder rights, roles, and responsibilities in rescue. So, just to recap where we've come from, pre-2011, all we could really do with companies that were in trouble were to basically put them into liquidation or insolvency. In round about 2007, the new Companies Act bill was promulgated, and I was quite involved in making submissions to government on the makeup of the business rescue legislation. And really what it did is it brought South Africa into line with international jurisdictions, how companies are rescued in Australia, the UK, to an extent in the United States. And in fact, the legislation was drafted by a bunch of Canadian legislators working with South African legislators at that time. So the Companies Act 71 of 2008 came into operation in May 2011, in line with what we say business rescue proceedings worldwide were becoming more and more increasingly relevant, and there was certainly a need to rescue companies rather than put them into liquidation. Everyone knows liquidation is the end game for a company. The liquidator would be appointed, he'd come in, take control of all the assets, sell those assets off at best, probably at fire sale values, and distribute dividends to creditors in line with the provisions of the Insolvency Act. And that's what business rescue tries to avoid, is rather work towards a rescue of a company, allow it to continue trading into the future after having compromised debt, or alternatively wind down the company and provide creditors with a better deal or dividend distribution than they would have got in liquidation. So as the slide talks to, the third bullet point, the objective of business rescue is to allow for the supervision of financially distressed companies by a business rescue practitioner, with the objective of either rescuing the company and allowing it to trade out of its financial predicament, or alternatively, if this cannot be done, it's not possible, offering the company's creditors and shareholders a better dividend than they would otherwise be achieved through a liquidation. Very important concept. It's dealt with in the definition of business rescue in Chapter 6, and it's something everyone needs to get their heads around. And really, as I said earlier, it's attempting to restructure financially distressed companies as opposed to simply liquidating them, which has been the new global trend over the last, let's say, 20 years. Business rescue is in line with what we call corporate rescue culture. As I spoke about earlier, international jurisdictions have been doing rescue of companies such as Chapter 11 in the US and administration in the UK. And I think for all legal practitioners, certainly those involved in advising from a financial perspective, whether it's an accountant, an auditor, and whether you're at a large firm, a small firm, you're all going to come across business rescue at some point in time. And I'm sure a lot of you have already come across the business rescue concept and have had to deal with it. So let's take an overview of business rescue now and have a look at more generic concepts from a, let's say, helicopter point of view. Business rescue provides an opportunity for a fresh start. In other words, companies get into a position of financial distress. They owe creditors a lot of money. They can't afford to pay their debts as and when they fall due. And there's a need to restructure that debt and compromise claims. Now, you can't do that unless you in some form of formal process. Now, liquidation certainly is not about allowing the company to continue to trade. As I said earlier, it would be the end of the company's life. Liquidator would shut down contracts, would shut down employment, and as I said earlier, sell assets off at best. So business rescue is something different. It provides a fresh start. It provides an opportunity to restructure the company and compromise debt. Now, of course, it's a creditor-driven process in the sense that it is all about debt and it is all about what is owed to creditors. So it facilitates that aspect, the compromise, as well as opportunities to restructure the company's business, its management, its contracts, and employees. So when we get to the business rescue plan a little bit later this morning, you'll see that the opportunities are wide-ranging and quite creative, actually, on the part of the practitioner. Not every business rescue plan is the same, even though the Act in Section 150 prescribes what should go into the business rescue plan. Often it is something that the business rescue practitioner puts together, having consulted all stakeholders, including creditors, management, directors of the company, potential investors, post-commencement financiers of the company, which we'll explain a bit later on, etc. So it's an all-encompassing negotiation or discussion once the practitioner is appointed. And as I said, it's creative. It reorganizes the company's business and its affairs. Most importantly, government were very focused on the preservation of jobs when they formulated this legislation in 2011. South Africa obviously has a very high unemployment rate, and if a company goes into liquidation, as I said, jobs come to an end. So business rescue is about preserving jobs, not necessarily all jobs, but certainly a larger portion than you'd find in a situation where there's a liquidation. It's about a better return for creditors. And what is interesting is that it's a new playing field for what we call distressed M&A, merger and acquisition activity. And we've seen over the last couple of years a lot of venture capital funds, hedge funds, private equity firms, distressed funds saying, we're interested in the asset. We'd like to put more money into the asset. Let's go through a restructuring of the debt. Let's compromise the debt. Maybe we buy the shares, maybe we buy portions of the assets, maybe we buy some of the subsidiaries and end up with some value going forward, which will enable the company to continue maybe its whole business or a portion of its business. So it certainly has provided a new playing field for M&A activity. And often it's an opportunity for these parties to pick up distressed assets at discounted prices. So as an example, company's in trouble, it goes into rescue, an offeror might come along and say, I want to buy the shares of this company for R1 because the shares are worth nothing because the company is one step away from liquidation or insolvency. But I'll put in 30 cents in the rand to acquire this company, 30 cents in the rand, offered to creditors, take it or leave it. Now, often creditors are faced, particularly concurrent creditors, with a zero outcome in a liquidation. They often would support a transaction like that. And the plan would then be voted in off the back of that transaction. And the third-party venture capital firm or offeror would end up with the company or portion of the company or with the shares of the company and continue into the sunset with that company going forward.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.